Welcome to the Big Mike Fund Podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in. Because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fund Podcast. I'm the Big Mike Zlotnik, and today it is my pleasure and a privilege to welcome back Whitney Sewell. Hi, Whitney.
Hey, Mike. Pleasure to be here again.
I love your accent, the Southern accent. You're back and you talk with a warm Southern accent. How are you? How's the world been treating you?
Yeah, it's good. It's been very good. Family's good. Business is growing, and projects are doing very well. We cannot complain.
Thank God. That's great to hear.
Yeah.
So, what's new? You launched a fund. I remember receiving an email or a couple of them, and so I'll let you, without further ado, introduce your own fund and talk a little bit about what has the fund done so far.
Yeah, it's still very new, and it's a closed-ended fund, which you're probably going to ask. It will not be open forever, but that wasn't our goal. We had done 506B deals, projects all up to this point, and so this is actually a 506C fund. And so this fund, though, is doing the same types of projects that we've been doing, up to this point. It's a value add multifamily, usually late 70s, early 80s vintage multifamily. And then we have approximately like 10 to 15% of the fund will be development. And we have 3 development projects going on right now. And the fund will actually own a very small portion of one of those. And just to give a different flavor there, a different asset class in the fund as well with the value add deals. And so that project, we actually closed our first deal in the fund about 2 weeks ago. And that was a smaller portfolio, about 140 units or so. And then we actually already own the land on the development piece, and that we'll be breaking ground on that very soon. And then we have 2 more projects under contract right now as well. That's all these projects are in Colorado and Idaho. Just so you know, that's our markets. That's where we are focused the most. And but yeah, that's the types of deals that we're focused on. Those 2 projects, we're hoping to close mid-December.
Congratulations. That's awesome to hear. Why Colorado and Idaho? I know Colorado is the most beautiful state in the country. The mountains are just breathtaking, but is there any other reason why Colorado and Idaho?
Yeah, early on, or a few years back, when I met my business partner, he actually lived in Denver. And so he had some connections there. And that helped us, start building some traction in Colorado, specifically Colorado Springs. And we made some great connections through a property management company there that we've just made good friends with. Really, they've been great partners. But then, as we closed a few projects there, right, we started to see more and more deals. More brokers knew we could close, and the traction just continued to grow there. But it's also a great market. I mean, Colorado Springs specifically has been a great market. I mean, it's had just continual growth for like 100 years. I mean, it's just been very steady. And so we like the market, and we just gained more and more traction there. But then also we got into Boise. We had some connections there as well. We closed a Class A project there. Our first project there was a year ago, this past August, 172 units. And that project alone is already surpassing our 3rd-year projections. And so that market also has just been exploding. I think like the first few months of this year, there were like 11 vacant units in the entire market. Just madness how fast it is growing there. And so we love those markets. We already had a footprint there. And so we decided to buckle down there in a big way and just continue to grow there. Also, our investors have loved that we are in a different part of the country that are also some good markets. So many of them are investing in projects, in the Southeast with other operators. And so that's kind of been in our favor, that allows them to diversify in that way as well.
Yeah, very cool. If you ask majority of folks that are looking for deals, you hear Midwest, Southeast, and Colorado. I don't know, what is it called? It's, I guess, sort of west, but I don't know if it's sort of southwest, sort of. But yeah, and Idaho is, I guess Idaho is Midwest, sort of, right? It's sort of in that, I don't know. But it is a diversification for sure. Although I've heard other folks going into Boise, it seems like a great market, like you said. So besides obviously building a strong footprint, and these are good growth markets, what type of, I guess, assets you're looking for? A's, B's, sort of going into C's? Is that particular, or it's very opportunistic? Whatever comes across at the right price, that's what you sort of invested.
Yeah, we have been focused on, I would say, a C plus type asset. Nothing where I'm afraid to walk down the street around the property. Nothing like that. And I would say these are C's because of the age, on the projects typically, not because they are in extreme disrepair. Most of these projects are, I would say all of them are stabilized. They're cash flowing from day one. And so there's nothing that we have to vacate half the property or 100% of it, to complete our business plan. They're usually, they're, like I said, they're cash flowing, stabilized as soon as we take them over. So we feel like that minimizes a lot of the risk as well.
Yeah, it makes total sense. Just a couple more words about your fund. So it's a closed-ended fund. Just curious a little bit about the structure. How does the fund structured? Do you pay a pref or a split? Do you have asset acquisition fee? Just curious how you structured the fund.
Yeah, so it's a 7% pref, obviously annualized, and then we actually did an equity multiple this time versus an IRR, and so it's a 3x equity multiple, a 7 to 10 year fund. We're leaning more towards 7 years if at all possible, but all documentation will say 10 years, but that's mostly just for as much flexibility as possible as well.
So it's a 3x multiple over 7 to 10 years. I don't know what IRR it comes out to be, but is there a split? Do you have, so it's 7?
Yeah, so it'd go from 70-30 to 50-50 once we reach that 3x equity multiple.
So it's 70-30 until you reach 3x equity multiple, and then 50-50.
That's right.
Okay, interesting. Yeah, it's different, and it's a growth fund because you said you're taking in ground up projects, some value adds. So your pref is going to be cumulative, but unlikely to be distributed from the day one, right? It's going to be at some point in a few years when you get some projects through the life cycle.
Right. So majority of the projects, or 90% of what's in the fund, will be value add, will already be cash flowing. So we'll start distributions at the beginning of the year. So actually in January, but obviously those will accumulate as far as, if we're paying a 4% the first few months, or, until all the projects are in the fund and closed, and that, and especially the one development piece. And like I said, that's a very small portion. Majority of the deals will be cash flowing, pretty quickly.
Yeah, got you. Okay, so it's a value add, but it's not heavy value add. It's not repositioning. Yeah,
that's right.
Incremental, so you can actually have some cash flow.
That's right.
Yeah, that makes total sense. What's the size of the fund? How much are you trying to raise?
We'll raise about 25 million. And actually, we may cut it off before that, depending on deal flow. And so our goal was for the fund to only be open for a few months, and we probably have enough projects under contract right now to use all the funds. And so unless another deal comes in pretty quick, we may go ahead and end it actually a little early.
Let me ask you the tough question. You may have enough projects, but do you have enough investors coming into the fund in a short amount of time to be able to fund all these projects?
Yeah, that's what I mean. Like we wouldn't end it early if we didn't have enough funds in there now. And so we have enough funds now for the projects that we have. So I mean, unless we have another deal pretty soon, we'll go ahead and probably close it. We don't want to leave it open past the end of the year either way, the fund. But we'll probably go ahead and close it pretty soon. Like I said, unless we get another deal under contract pretty soon, just so that way we can allocate all the funds as fast as possible as well.
Yeah, that's great. So if you basically went from 0 to 25 million in pledges in how many months? I mean,
majority of that was within the first couple of weeks, maybe 3 weeks, something like that, around 20 million or so roughly. And so like I said, we may leave it open and get closer to 25 million, but we're around 20 right now. But most of that happens, within the first few weeks. And then there's still obviously more investors trickling in, but like I said, we'll probably close it pretty soon.
That's great. That's really impressive from the capital raising perspective. Essentially, you promoting 7 to 10 year fund, which is pretty long time horizon. And a lot of people are not crazy about the lack of liquidity. And obviously, you're pretty open about the fact that there is no liquidity. You park the money in the fund and it's going to be 7 to 10 years. So it just means people really like you.
Well, thank you. Yeah. I mean, we will do some refis and things like that will provide liquidity, back to investors, over the life of the fund. But yeah, it's been a long road getting to that deal, getting to that place, where we can raise those kinds of funds, and just the trust, that it's taken, to the time it's taken to gain that trust from our investors. But yeah, a lot's happened, in that time to make that happen. Let's see, there's something else about the fund I was going to say, but I can't remember at the moment.
I'm sure you'll remember. Feel free to jump. So now let's shift the subject a little bit. Thank you for the introduction of the fund. What's the name of the fund? What's the, first of all, at the end of the discussion, we'll ask the question how the people can get a hold of you, but let's answer the question now. Say, folks, we're, wanted to ask a couple of questions about the fund and what's the name of the fund.
Yeah, I appreciate that. Well, it's a very strategic name. It's called the LifeBridge Capital Fund One. So LifeBridge Capital Fund One, obviously lifebridgecapital.com. You can learn about our current opportunities and see more details about the fund, and get in touch where you can talk to me or somebody on our team to learn more about it.
Yeah, that makes total sense. You utilizing your primary brand, which is great. All right, so let's talk a little bit about the outlook. So obviously you're making the investments, and you're pretty optimistic about these investments. Otherwise you wouldn't be making them.
Right.
So what is your kind of outlook into the next year? Again, it's really difficult to project many years out. You can only do kind of your generic or general trends, which markets are good, like you said, Colorado Springs or Boise, Idaho, based on the past 10 years, what's the next 10 years will look like. But year out, what are you seeing in the just general real estate? Are we still going to continue this inflationary environment? Rents are rising faster than before. Is this something that is here to stay for a little bit longer, or we are going to run out of steam once the government stops spending all these dollars, that inflation will come back to where it was around 2% a year versus where it is now?
Yeah. Well, I have all the answers. You know that, Mike, right? No, I'm optimistic, especially for the next 6 to 12 months. After that, I'm not so sure, I'm not sure how long I expect this to continue. But I really go back to basics in how we're buying deals, and all the things that we all talk about often, in how we buy projects, meaning having adequate reserves, having long-term fixed rate debt, those things, cash flowing projects that help us. So when that happens, that we're prepared for it. And there's a project that I often use as an example. We purchased a project a week before they shut the country down last March. And 216 units, about $28 or $9 million project, class, or is like a C plus. And we had $1.5 million in a reserve budget from day one. And often there's other operators that invest with us. They're investing in that deal. And a couple operators who I respect in a big way, they were like, Whitney, don't you think that's kind of excessive? And I was like, maybe, but we're going to sleep a lot better, knowing that those funds are there. And so, don't you know, like I said, a week after closing, they shut the country down. And we were so thankful that we had those funds, right? The emergency budget allocated. I mean, it was separate from CapEx and those things as well. And so thankfully we've not had to use those funds, but, and we've not missed any distributions, any of those things, through the pandemic. But steps like that help us to prepare for when, that happens in the future. But specifically, I'm optimistic about the next 6 to 12 months. And I feel like if you have some, strict buying guidelines, where you're buying projects, like I said, that hopefully are stabilized, cash flowing, that you're going to be just fine. Even our development projects will be done within the next probably 6 to 8 months, right? And so our goal obviously would have them to be leased up, especially before 12 months out, because after that, I don't know what to expect. I don't think anybody does know what to expect. However, we can look back at what's happened, in previous years and to make our best judgment, right?
Yeah, that's exactly right. You can only foresee, I guess, that it's, there are many opinions on this, but
right,
practically it's within 1 year, and especially political environment can change with the midterm elections, so that all that is going to be up in the air. But I completely appreciate, and love the fact that you capitalize the project with extra cash. Not many sponsors do, honestly, for the reasons of if they want the IRRs to look prettier, overcapitalizing and having a lot of cash typically dilutes the equity, and it's not as exciting for investors.
Right.
But at the same time, it's a safety element. So if we're talking about what to do now, how do you build safety going forward? And increasing cash is one of the safety elements. By the way, what other safety elements are you thinking about today? Obviously, cash flow from day one. Anything else you could sort of do to reduce the risk, even on the new construction projects? One of the big risks today is the new construction is going to run into delays, cost overruns. So that's why I asked the question. When you said new construction, it's a wonderful opportunity if you can execute well. The challenge is supply chain is still kind of substantially disrupted, and we still hear a lot of continuous escalations of costs, and it doesn't seem to be no end in the tunnel. It's the cost escalation tunnel, and so how do you mitigate the risks associated with construction delays and cost overruns?
Yeah, that's a great question, and something we've talked about in detail or thought about. One way that we've done that is partnering with a developer who's extremely experienced in that market. And so, we actually purchased a project from a developer a year or so ago and developed a relationship. And now we're going to buy projects from him, or, put them under contract early, and then ultimately close on them once they're finished. But one way around that is because he's been in this market for 20 years developing projects, and he's already allocated, a certain amount of materials. And so even if there's a shortage, a portion of that is already his. And so he can already count on a certain amount, right? And that goes through having very detailed conversations with him about your specific projects, right? So I am not the developer. Try to make that very clear. I'm not the professional developer. However, I have to understand a lot about what's going on, of course, but it's by continually growing that team of experts, and even experts inside that specific market, right? So they understand the development piece better than I ever will. But that's been one way to hedge against any kind of price increases, things like that, is because he already has most of these materials actually on hand. And so that was a big part of raising our comfort level to do a deal like that as well.
Great comment. So really important question: are you buying the asset from the developer upon certificate of occupancy, or you already bought the asset and you're using them as a general contractor on the asset, where you eat the cost of the delay and overruns, or does he eat the cost of it? Sounds like in this case, the cost overruns and the time overruns is the developer's cost. It's almost like you're closing upon the certificate of occupancy.
That's a great point that you just made. So we have a couple of both of those right now, but that one specifically, yes. So we put it under contract, but we will not close until it's occupied, right? Until we get the certificate of occupancy, like you mentioned. And so therefore he is eating those costs and those expenses, at the moment until it's complete.
Yeah, that's a great strategy. I've actually seen this strategy a few times, talking to a few folks that they want to buy a new product, but they want to remove the risk of construction. And the only way you can do it is you go under contract prior to completion, but you don't take the asset until it is completed. At that point, even beyond completed, it's completed and stabilized. So is the contract contingent upon the developer finishing obviously the property and receiving certain rental rates?
He is. So it is. So we're actually working pretty closely with his property management team because they'll be handling most of the lease up, but we want to be very involved, as we can, obviously, in that lease up process, and actually, kind of joining our management team there, in connection with theirs through that process. And so, but it is contingent upon certain rental rates that are, current in the market, and then a certain level of occupancy as well.
Got you. Yeah, makes sense. So yeah, that approach is a safer approach. You obviously wind up paying a little bit more for the asset, but you are taking it with lower level of risk. You're buying it as if it was completely stabilized based on a pro forma, not taking the risk of construction, which is a substantial risk, as you can imagine. Typically, the upside has to be a lot greater if you're pre-buying the property and you're carrying the development risk, which is a very different beast. So
yeah.
Makes sense. Let's switch and talk a little bit about, again, you mentioned the pre-COVID project that you basically entered. How's the project doing? Just curious, how the rents are you seeing? What kind of rent increases are you seeing across all your projects? I mean, curious. We all know there's been a substantial inflation. Some parts of the country a lot higher than others. And it's been, everything has been on fire, sort of. So just curious, what's your observation on that project? What kind of numbers? Again, we've done similar things. We've entered into some deals just before COVID or even after the COVID hit, and the numbers are just staggering. These IRRs are through the roof. It's almost like if this continues, I mean, the numbers are not what you project. They wind up, a lot higher than.
Yeah.
So.
Oh yeah. Yeah, it is. It's been staggering to say the least. So that specific project, it will actually, we got an off-market offer on it already, and it's under contract to sell within a month. And it will be a 2x equity multiple, in 18 months or something. And so it's just staggering to say the least. It ended up being a 50 or 60% IRR.
Yeah, it's funny. We have exactly almost identical situation. One project literally under contract for 2x plus in 18 months, which is 60% IRR if you run the IRR formula. And with another one, I think you've heard me speak about hotel to multifamily conversions. That's been another massive home runs. I mean, we had one that exited on last Friday with an IRR of like 140%. It's a 2.6 multiple in 13 months, something like that.
Wow.
Yeah. So these deals are, it's kind of funny when we're sitting here and what we're doing. When you're going to run the fund, you're going to do a little bit of this math, and it's not necessarily critical math, but it's a helpful forward outlook math, especially when you have a portfolio in a fund. So some of your deals do really well, and you try to basically project how the early deals are impacting the overall future performance, which is very hard because you don't know what the future performance is going to be.
Right.
But it's the mathematical exercise. Hey, we got 60% IRR on this one, we got 140% on this one, and so on. How is that impacting a fund? That's a fund manager's problem, right? You know how some assets are doing, some you don't know because they're too early in the cycle. But it's helpful to do a little bit of that kind of analysis. So I mean, you'll have that problem when you build enough assets and you start seeing how these things are performing. So. Any other quick commentary, any other quick thoughts? What else is new in multifamily? You talk to a lot of people, you have a wonderful podcast. So what other things, great ideas, great thoughts you're hearing in multifamily? I can tell you that what I'm hearing is everybody's just, not happy with the prices. The competitive deals are just flying off the shelves, people overbidding, sort of momentum plays. And we've kind of looked at number of deals, and I mean, it's getting a little crazy. You want to bid 24, 25 million, this thing flies off 26 and a half. And even those, those numbers don't appear to be massively higher, but they're big enough to impact the IRR substantially. And are you still seeing very aggressive buying, people competing, especially on the market deals, just brutally competitive? Are you looking for any market deals, or most of your stuff completely off market?
I would say most of it's off market, and some of this is all tied together there. You ask about, what I'm seeing and some of that. I would say even the project we were just talking about. So we closed that project and built a relationship, right, with that seller through just a smooth transaction, closing on time, doing what we said we were going to do, all those things. We actually have 2 projects under contract right now with that same seller. Okay. And so because they had worked with us before, they actually took even a lesser offer from us than what they had because of the relationship that we had. So it was like, they'd reached out to us and maybe one other group or something. And we had a previous relationship with them. And so they went with us. And so we're thankful for that relationship. But still, that was, just time in the process, all right? Time in building those relationships. So even now we can get deals that work. Outside of that, yes, it's just extremely overheated, and it's difficult, obviously, to find stuff that seems to make sense. I don't think any of us know exactly what makes sense at the moment with some of the prices that people are willing to pay, because often, more times than not, we're not comfortable, paying as much as what so many people are. Even like selling this project, like, you can always second guess yourself, right? And say, well, what if I held it till the spring, or what if I held it another year? And we're going to say, hey, if we can provide those returns that we projected to investors in 18 months, why would we not? And do right by our investors as fast as we can, and what we know we can do right now. But moving forward with new projects, it still goes back to those same fundamentals that we said before. Can I provide a certain amount of return to our investors while still having, fixed rate long-term debt and adequate reserves? Those things, is the property going to cash flow? Even looking at like break-even occupancy, I was going to mention that earlier. That project in Boise, it's like a 48 to 50% break-even occupancy, like things like that. It's already surpassing its third-year projections. So, we can move a lot on that, as far as coming down in rents and having adequate reserves, all those things, and even a high vacancy rate, and still pay our bills, on something like that.
Yeah, it makes total sense. It's a stress testing.
Right.
I just had another guest on the podcast. He's actually an REA and a financial planner. And this is one of the concepts that we were chatting about in this uncertain environment, with the high degree of uncertainty of what is going to happen in Congress over the next, few days, weeks, hopefully not months and years. But the only thing you can do is really stress test your portfolio, stress test your investments, and at least have the knowledge of what would happen if these things change, and how they, how it stresses the investments. And obviously, this is one huge unknown. And what's going to happen? We're recording this, middle of second half of October, and we don't know when it's going to come out in a little bit. But if IRAs get impacted for any 506 anything, B or C's, they both require accreditation. If they don't allow accredited investors for IRAs to participate, that will be a problem for the entire community. But are you doing anything? Are you thinking any creative ideas how to manage if this were to happen? Especially if you got investors in your projects, your funds, is this impacting your marketing? People getting a little kind of, sitting with it on their hands, getting just wait and see what happens, or people don't care, they're just taking action for now and then see what happens later.
Yeah, no, that's a great question. And I don't have a great answer other than, yes, we are trying to prepare for it, or at least like think through and have some kind of process. Our investors are definitely reaching out, and, or many have reached out and said, hey, what do you think about this? Or have you seen this? And I'm like, yes, so we've seen it. We are trying to prepare for that just in case it happens. What are our options? Even talking to our attorney or other operators too, like, how do you all plan to rectify or to make this happen, to get these investors out of these deals, in that short of notice. And I think depending on how the market goes, if they have, they may have 24 months or 18 to 24 months to get their funds out. Oftentimes, many projects, depending on how the market goes, may be closed or sold by then anyway. That you have, or a few will maybe, but the ones that we're buying right now, they probably wouldn't be, right? Most likely. So we would have to make a way to buy those investors out, and obviously we want to be good, do good by the projected returns, things that they're owed, but we got to get their money out if that's what we're made to do.
Yeah, that'll be an interesting conversation if you can take them out. I spoke another podcast guest, which was an interesting conversation. And he's gearing up to buy out some of these investors out of existing projects, almost like if the problem hits, then the supply demand of the money, if a lot of IRAs need to exit, so there's a lot of sales pressure, and obviously it requires consent of the sponsor. But the gentleman I spoke with, he said, listen, I might see some great opportunities. It may have to be a balancing act because you have to meet the demand. The alternative is, which is not basically a valid idea, is distribution in the form of that asset, which is not ideal, but
Right.
that's kind of the only solution if you can't get liquidity, right? Otherwise, the whole account becomes no longer qualified account. So it's another.
Yeah. So that may cause some deals to be had as well.
Yeah. We'll see what happens. This whole, from everything I heard, is the Congress has just created them. It's a couple of aides to senators and members of the House that have come up with this extreme version of it without really even the members understanding what they just put together. That it's not just one billionaire guy, Peter Thiel, with a $5 billion Roth IRA. It's just it's almost like so impactful on millions of small investors. So the problem they're trying to solve, the solution is maybe solving that one problem but hurting a lot more people. So
right. Yeah.
All right, Whitney, I appreciate your wisdom. We kind of passed, we're approaching the end of the great podcast. Any final thoughts? Anything new? Any new book? Any new? Well, maybe you have a great episode on your podcast. Anything interesting? And how would people get a hold of you? Yeah,
I would encourage people to go and listen to show WS 1000, 1001. And then it's 1007 and 1008. It's a 4-part series that actually my wife and I did together, just about our process, our journey in getting into this business. You will learn a lot about me and my family and our real estate business and just our journey getting to where we're at. So I would encourage you to listen to those episodes and obviously go to the website, and sign up at lifebridgecapital.com. You can email me, Whitney, at lifebridgecapital.com, or you can call or text me 540-585-4338.
Well, that's wonderful. You shared your phone number. Hope the phone. I hope you don't get too many phone calls because I don't give out my cell phone anymore. I
hope I get a bunch of calls.
All right. Good luck with that. I appreciate you. Thank you for your wisdom, and great to have you back on the podcast.
Thank you, Mike. My pleasure.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike's slot name. Keep listening and keep investing Big Mike style. See you on the next episode.